Hello everyone. So today we are going to discuss on the topic of FII selling. The topic FII selling is gaining pace and being heard in almost all the news heads these days. So as promised to many of you, I'll be decoding almost every aspects related to FII investing, FII selling, what is an FII, what is a DII and all those terms and what are the things which are impacting the FII selling and why are they selling and what is going to happen if they are selling continuously and when are they going to stop selling and what is the impact of FII selling on our economy in a shorter and a longer term perspective, how is it going to impact your investments. So all these things will be in detail covering in this session. So I request you guys to go through the entire video till the end so that you capture all the aspects of this, which will really help in your investing journey. In the current scenario of inflation hitting high for various countries worldwide, including that of India, the Russia Ukraine war, earnings of companies worldwide dropping, though our Indian companies have contributed good earnings results if you see on a larger perspective. Market falling heavily every day, and that you also hear that fall is mainly led by FII selling shares and exiting out of India and other countries as well. Even you must have heard that DII is buying, that is the domestic institutional investors, DII is buying and preventing our market from a deeper fall. So in this session, we will explore in depth who are DII and FII and we'll learn how the market is impacted by their actions, and also we'll try to cover the probable insider games by institutional investors as well. As a disclaimer, purely the content is based on my own in-depth personal research, and if anyone has a difference of opinion is free to comment below in the comment box. As always, let's get to the basics. Who are FIIs and DIs? So FII are foreign institutional investors and DII, as the name indicates, is domestic institutional investors. In the stock market, share prices are impacted by the actions, that is either buy or sell, of investors or traders. People like you and me are categorized under retail category. Those are the retail investors. The institutional investment is the investment done by institutions or organizations like bank, insurance companies, hedge funds, pension funds, mutual fund houses, etc. in the financial or real assets of a country. These investments can be domestic or foreign. The investments within India is domestic and outside India obviously is foreign. So the institutional investors already we discussed above who all are they. So in the domestic institutional investors, DII also includes provident funds as well in case of India. So retailers FII and DII form the critical part of the market. DII use pooled funds to trade in securities and assets of their country. FII and DII are same as far as the institutions are concerned. Only difference is FII is foreign to a country and DII are in-house institutional investors. Normally, I have seen that DII has the moral compared to FII to hold the own country stock market stable, since FIIs may come and go as per their investment rationale. So as here we are discussing about various types of investors, let me also discuss about the types of investments as far as the foreign institutions are concerned. So on the screen you can see FDI, FPI and FII. So FDI is foreign direct investments, FPI is foreign portfolio investments, and FII are, as we already discussed, foreign institutional investors. So FDI is investment in high yielding assets like plants and machinery of a business. So this is like the investors from outside India directly invest in the company, not through stocks or bonds, but directly taking some stake in the company by contributing positively to the capital requirement of the company. This gives rights of ownership as well as access to management decisions. They can engage in decision making of the firm as well. Normally, they have long term approach. As the contribution by FDI are too high, it's hard for such investors to exit from the company so easily because they have trust in the company, they have invested heavily, and they want to grow with the company and make money. So they are not like FII wherein they come today and go tomorrow. So that's about FDI. Now FPI includes investors in financial assets like mutual funds, stocks, insurance companies, etc. Now the last session is FII. So FII, as we already discussed, brings FPI into a country. So hope this all these three terms and what is their meaning, all these things are clear to you. If you see out of last 20 years, FII has only pulled out money out of India only for 3 calendar years, that is 2008, 2011 and 2018, even after steady currency depreciation, dollar value increase that is, and worldwide disrupting events. Nearly 22 to 23% of the BSC 500 is owned by FII till 2021. So it is interesting to note that nearly 55% of the stake is held by promoters, which are the company owners, and 23% or 22 to 23% by FII, and 13% by DII, and 6% by retail investors, and the rest by miscellaneous. So if you see 23% is like, if you round it to 25%, is 50% of the float value. So if you see 55% is promoter holding, so the remaining only is the stake which can be volatile, because if you see promoters normally don't buy and sell frequently. Buyback and all are one time events, but if you keep that apart, promoters will not actively participate in trading. So rest of the 45% only is actively participating in the trading and huge fluctuation in the stock price. So FII, which is holding 20 to 23%, is like 50% of that float value. So if there is a fluctuation in FII selling or buying, it will really impact the stock price and hence the stock market and hence the entire stock market economy. So that is the importance of FIIs. So you would be wondering, there are some companies, say Infosys and all, wherein the promoter holdings are less. So I am not talking about company specific stocks, but on an overall basis, if you see, the promoter holdings will be much higher, above 50%. And as I mentioned in my earlier sessions as well, I look at companies or stocks wherein the promoter holding is more than at least 50%, so that it shows the confidence of the promoter in that company, and we are also safe while investing in such stocks. So FIS have been attracted to India due to rising hope for strong economic recovery, strong earnings growth, a weak dollar index, and government's seamless measures. Also, major factor being India being an emerging developing country, investing in developed nations won't fetch multi-bagger returns, as I have mentioned in my earlier videos as well. In 2022, the monthly SIPs through mutual funds is around 12,000 crore, while it was 8,000 to 9,000 crore in 2021. So that is how the retail investors are actively participating in the market. So I mentioned earlier, mutual funds are part of DII. So a increase to 12,000 crore from 8,000 crore is definitely contributing to the power of DII, and hence if FII sell also, DII can support the market to such extent, which we are currently seeing in the current market scenario. To take an instance, From April 2021 to August 2021, DII inflow is at 7.1 billion US dollar versus FII flow of just 2.4 billion US dollar. During such period, Nifty gained around 15%. So did you know till 1980s Indian stock market was mainly consistent of in-house investors, which is the DII. Later, since 1991, post liberalization of Indian economy, FIS has been allowed to invest in Indian stock market. As FII investment in Indian stock market is very high, they are crucial from market moving point of view as they buy or sell securities in large volumes many times as basket orders. So again, as per rules and regulations of SEBI, FIIs can invest only up to maximum 24%. So their investment had gone as high as 21-23% in some time earlier, but now again that has dropped. So those statistics we are going to discuss further in this video. If you see in last 2 months, Warren Buffett has been investing in the US market as market has dipped to a very lower levels. He has been heavily investing in companies like Apple, Chevron, HP, Occidental Petroleum, Activision, Blizzard, etc. Even he has taken huge stakes in all these companies and further average his position so that he takes the appreciation of these stocks as the market bounces back. So market bouncing back is a very normal phenomena, but our entry price is important so that we take advantage of such market corrections. So let's get to some real figures. On the screen you can see the FII and DII buy or sell data. In April 2022, FII net sold more than 40,000 crore in Indian cash market. If you see the figure in May 2022, FII net sold the highest ever, which is more than 54,000 crore. So all these crore figures, you note that this is in Indian rupee. So the $1,000,000 question is why FIIs are selling continuously in Indian market. There is actually a combination of factors. As you know, inflation has grown high for all the nations, including that of India. The respective central banks, so central banks are like US Fed Reserve for America and Bank of England, etc., to suck out the liquidity and strengthening the dollar. Central bank has been pumping money into the system for increasing liquidity by purchasing bonds from commercial banks and financial institutions. This kept the interest rates low. But to arrest the excessive liquidity, especially which was made during the pandemic wherein economy needed a revival, this excessive liquidity has increased the inflation much higher. So to arrest the rising inflation as well, the interest rates were aggressively hiked by the central banks. Due to higher interest rates, the company profit will shrink since, as you all know, companies needs loans or debt to fund their growing business needs. So as the interest rates increase for their huge loan amounts, the overall profit contribution reduces, affecting the earnings of the company. So as you know, if the earnings are low and the price remains the same, the price to earnings increases. So price to earnings ratio increases, so the company becomes overvalued. So FIIs opt to pull out money off the market or out of the stocks since investing in overvalued stocks have risks of lower returns compared to safer investments like bonds or other fixed return risk free financial instruments with higher returns. Also, it's interesting to note that if FII pulls out money from India by sell off of the stocks, then demand for INR reduces, Indian rupee reduces. This is because as they have to buy rupee by using their dollar currency. So demand for rupee increases and hence more demand means the value of rupee increases So the rupee to USD value drops. Conversely, as the rupee to dollar value increases, then FII can buy more of stakes in stocks with lesser dollars being spent. But as they sell off and exit out of India, the reverse happens and the rupee depreciates, and their impact has a cascading effect on our GDP. As the rupee value drops, the imports also becomes costlier as we have to pay more for each USD, and reduces our overall profitability of finished products. But this will boost the exports. More exports and lesser import means the current account deficit reduces, which is good for our economy. But there should be a fine balance between current account deficit and FII inflow. But many times, if you see, the FII inflow boosts the GDP of countries like India than the higher exports. Since the FDI and FII together helps boost the economy to much higher levels by providing capital for growth of organizations and hence better profitability. So again, I take a pause here and request you to go through this video at least 2-3 times to get the entire concept, because I have tried to condense many of the core concepts into a single video. Maybe the video is lengthier, but I am trying to condense all the data into a single video so that you are completely enlightened by the data which I provide to you. FIS earlier used to decide the mood or so called trend of the market by their voluminous huge trades. But unlike old times, due to heavy participation by retailers and even DIIs through mutual fund routes, etc., in Indian market, though FII sells heavily, the other team buys and supports the market, which we have practically and very clearly seen in these days live in the market. You can again see the FII and DII trade data on the screen. You can easily identify that when FII sell or buy, the DII does the opposite and balances the market to a greater extent. So the curve spikes are always opposite if you see in the screen. So end of the day, it's a buy sell game. The loss of one party is the gain of the other. But it is to be noted that, as I explained earlier also, FII and DII are huge group with different institutions. So a particular firm or institution of FII may sell on a day, and another set of FII would be buying as well on the same day. So what we see as negative these days, like FII selling 2000 crore, 3000 crore, 4000 crore, is nothing but the net sell. Means a set of FII sell 12,000 crore and another set of FII buy 10,000 crore on the same day. So the net outflow of FII money out of India is 2000 crore, which is 12,000 minus 10,000. So 2000 crore is only the net sell, because 12,000 crore though sold by FII, another set of FII has already bought 10,000 crore. So don't be under impression that FII is only selling. There are huge lot of FII which are also buying as the market goes down. So that they apply the principle of value investing there. It's all dependent mainly on their initial price and how much they have gained, and that is it time to book profit. So FIA are not different from we retail investors. So we also invest money at a lower price. Once it goes to a higher price and if it hits our target, so they sell. So we are like value investors who believe in growth of businesses and creating value over a longer time. But many times FII don't think in much larger perspective, and due to the reasons I have explained earlier, they have selling pressure and they sell off and book their profit. During turmoils and uncertainty persists, like war, like our Russia-Ukraine war, pandemic situations, and where inflations go so high and the interest rates are hiked, the FIS try to be safe and book profit. If you see during pandemic and all respective governments had to boost the economy by injecting liquidity to the market through means of provisions like infrastructure spend infusion, special farmer allowances, etc., which increases spending and boosts economy. But when pandemic subsided, the extreme liquidity made the country to go to high inflations. We can't expect somebody to hold the stocks for infinity. They have to book or realize some profit at some point to make this rewarding. So again explaining, as explained earlier, as the inflations increase, then Fed in case of US increases the interest rate to arrest the inflation, then the bond yields go up and FIs tend to book profit in risky equities, say in Indian market and other developing markets, and invest the money back to safer fixed income instruments like bonds and even gold. And this is quite a common logical phenomena we can see. So as I mentioned earlier, if FIIs sell some percentage of stake in Indian market, say BSE 500, it's also to be noted that FI still has 18 to 19% holding in market, and if DIIs or retailers don't buy when FI sell off, then FI also will get into great trouble, as this 18% holding will go in deep losses as markets go down. So FII study the pulse of the situation in market and sells only when they are sure that DIS or retailers will hold the market from falling too much, so that FII make money by both taking partial profit and also their retained holdings of say 18 to 19% doesn't suffer as well. If you see on the screen, FII has been selling heavily, so almost a 21 to 22% holding in BSE 500 Indian stock market has fallen to 18-19% levels now. The market will definitely bounce back from long term perspective, but yes, traders, as they have short term positions, will be the one to lose heavily without any recovery. For value investors like us, it's always an opportunity to buy in such dips and hold long in quality businesses or stocks. It is always to be noted that market may always come down temporarily, but it has to regain momentum and shot up back to reach higher levels as far as the world exists. The earnings growth of the company also helps the particular stock to reach higher levels. Again, my personal experience is that new investments will come into the market and the market will go to much higher heights than current levels is only when the market corrects severely, so that the investors, whether it is FII, DII or retail, finds value in the stocks and invest much more than what they had invested earlier, so that they gain confidence because they feel it is safe to invest at lower price, which is correct also, and the market shoots up to very higher levels. So that is how a correction is very much important. This I had earlier explained in my market correction video as well. So as value investors, I am telling you, if FII are selling, take this opportunity to invest in quality stocks which are available at a cheaper rate than earlier times, and invest for longer periods, and this will give you multi-bagger returns for sure. For now, taking a leave. Happy investing.